Every financial system ends the same way. Too much debt, too little trust, and money that quietly loses its value. You don't see the collapse when it happens, but you certainly feel it. In higher prices, in slower growth, in the constant pressure to run faster just to stand still. The signals are everywhere. Wages rising slower than rent, groceries climbing while inflation headlines cool off, markets floating higher even as productivity stagnates. That's not random. It's what happens when the foundation of money itself starts to fail. Today, we're living through that slow motion reset. The dollar isn't dying overnight, it's melting. Piece by piece, purchasing power leaks away while the world quietly rewires how value moves. And while most people argue about whether we'll have inflation or deflation, Bitcoin is positioning itself beneath it all, not as a hedge, but as the next layer of money. Before we dive in, if you want to stay ahead of these macro shifts, make sure you're subscribed to the Crypto Nutshell, our free 5-minute daily newsletter read by tens of thousands of investors who want sharp, actionable insights without the noise. First link in the description. All right, let's get into it. The United States is more than $37 trillion in national debt, an amount so large it barely means anything anymore. But it's not the number that matters, it's the speed. We're adding over $2 trillion in a single year, in an economy that's already at full employment, with tax receipts near record highs. That's the tell. The system now requires debt just to keep the lights on. When debt grows faster than productivity, policymakers have only two paths left: default outright or default quietly through inflation. One ends in panic, the other buys time. And for the last 50 years, they've always chosen time.
There are many other currencies that are as bad as the dollar is. There are other currencies that are worse. And that's what's one of the things interesting. I commented on this in another podcast. You meet people from other parts of the world and they tend to get Bitcoin. They tend to get our thesis a little bit more easily than the average American. And that's because they've lived it. I had a podcast with a guy who was a teenager in Argentina when Argentina went through hyperinflation, and he described it. And so when Bitcoin came along, he was like, gosh, I get it. I know what the problem is. And, with all of America's faults, and it has plenty, the currency has been healthier than most other currencies in the world for a long time. And so the average American kind of has a hard time thinking outside the box and saying, this thing could actually fail, which is it's a very scary thought. And I'm not hoping for that. I'm not wishing for that. I'm not, somebody on Twitter jumped on me last night for saying I'm a doomster, talking about hyperinflation. I'm really not. I'm very optimistic about how good the world will be in the future, about where we're ultimately going. But I think to analytically look at what's happening and not come to the conclusion that we've got a serious problem, that's being an ostrich and sticking your head in the sand, because the problem's very real and obvious. And it's screaming at us in so many, dimensions. We could talk about those, but it's a record gold price, the record Bitcoin price, the failure of the bonds and the bond markets falling off, except you name it, we can see it.
That's the quiet default we're living through now. Your salary still arrives, your savings still show the same digits, but what those digits buy, a home, a car, a week of groceries, erodes month after month. This isn't political anymore. It's structural. A currency based on ever-expanding credit can't tighten without breaking its own plumbing. You can raise rates for a while, you can talk about discipline, but math always wins. And history shows how this story ends, not with collapse on a single day, but with confidence bleeding out over a decade. Every time central banks try to fix inflation by tightening, something cracks. Rates go up, growth stalls, markets wobble, and suddenly, the same people who promised restraint are flooding the system with fresh liquidity, because that's the only move left.
As we know, COVID created a lot of inflation. The peak monthly inflation rate was 9%. And then when Powell saw that, and of course he said it was going to be transitory, and he was dead ass wrong. And that's what happens when you have a lawyer as Fed chairman, doesn't understand economics. And he immediately swerved and slammed on the brakes and jacked rates faster and harder than almost any other Fed president had ever done. I think Volcker might have done something similar, maybe a little more aggressive, and of course that very quickly slowed down the growth of credit and the growth of M2. And so we actually did see an M2 decline into the tail end of the Biden administration. But what we also saw was that in 23, the bond market started to have a fit, and the 10-year went above 5%. And suddenly you had, September particularly, you had all the Fed governors, 12 of them, come out and say, well, no, this rate hike cycle is over. And they realized they'd gone too far, and they were able to bring the headline inflation rate from 9 to 3 round numbers. Some are 2.7, 2.8, depends on which measure you use, but call it around 3. And now I think we're setting up for what I call, the next wave of inflation. And you can see that in a lot of different ways. I mean, you can see it. I mean, first of all, let's just discuss the fact the inflation numbers aren't real. We all know that. They're cooked. It's worse than they say. Anyone who goes to the grocery store, buys auto insurance, buys homeowner insurance, or, I mean, damn near anything. I mean, there aren't many things in the world going up at 3%. I tweeted out last week that electricity in the United States on average is going up about 11% a year as a result of all the increased demand from AI. So, the inflation numbers aren't even right. And yet, in my view, they will probably get worse because Trump's desire is to cut the rates by 300 basis points, and that'll lead to a wave of home equity refis. Everyone who took out 7% mortgage, you go back and take out a 3% mortgage, and credit will start to grow. And as you pointed out, right now, M2 is growing at about 4.8% a year, just hit a new all-time high. And this is the problem with the system, as described in the book, as we all know. When you've got a system based on growing debt, it's like being a shark. You got to keep swimming forward, or else you don't, you die. And so they have to continue to increase the money supply, or else the debt pyramid collapses. And of course, they're in the process of doing that. And it's clear that they're having some troubles. I mean, earlier this year they reduced the amount of quantitative tightening they were doing from 30 billion a month, or I think 25 billion a month, down to 5. They're still doing the mortgage-backed bonds. And so they've been shrinking their balance sheet less quickly.
We've seen this cycle on repeat since 2008. Tighten, break, print, repeat. Each round, the intervention gets larger, the response time faster. It's like watching a patient on life support where every dose of oxygen needs to be bigger than the last. That's why markets no longer trade on earnings or valuations. They trade on liquidity conditions. When the Federal Reserve expands its balance sheet, risk assets surge. When it drains liquidity, volatility spikes. And in a debt-based system, you either keep expanding the money supply or the pyramid collapses under its own weight. So when you see M2 back at record highs, don't call it stimulus, call it survival. Because once the economy becomes addicted to easy money, the exit ramp doesn't exist anymore. For thousands of years, every form of money shared one fatal flaw. It could be created at will. Kings debased their coins, banks overissued notes, governments printed promises. That flexibility kept the system running, but it also guaranteed that eventually trust would erode. Then, for the first time in history, a form of money emerged that no one could inflate, dilute, or counterfeit.
I mean, pre-Bitcoin, gold was sound money. It was your only choice. It was your soundest choice. And obviously, Bitcoin is sound money too. It's digital sound money. It's in so many ways superior to gold. But, I always remind Bitcoin people, you got to remember what got us here. And you got to remember how good things were on the gold standard. They weren't perfect, but they were better than they were on a fiat standard. And
Yep.
And when we got off the gold standard, that started the slide. And of course, it's that slide that then led Satoshi to develop Bitcoin, because as we know in Block 1, he said, chancellor on the brink. And and he in a lot of his writings, he talked about how the abuse of the money printing privilege was a big reason for the invention of Bitcoin, because central banks will always and have always abused that privilege. And the thing I think is so unique and interesting about Bitcoin, I think it makes it very hard for most people to understand, is this is the first form of money, and this is why Jesse Meyer, who I love, says this is once in a millennium kind of, or once in a species kind of event. Is every form of money used by mankind, and we've used tons of things. We use beads and salt and grain and livestock. There are lots of forms of money. Yap stones, whatever. But every one of them had some, you could create more of it. There was an additional supply somehow available. And we all know that any commodity like gold or oil or anything else, if the price goes high enough, we'll find more of it because somebody will be rewarded to do so. Here you are with Bitcoin. Okay, so turn that on its head. And this is why it's going up forever, Laura. Turn that on its head. We actually have a form of money with a fixed supply. And it's like, boom. I mean, it's just mind blown. That just did not exist. So forget all your, this is why sales says your models are broken. Forget all your models. Forget the past. Try to think outside the box and ask yourself, if something really like that changed and it's that significant, what are all the implications?
A fixed supply monetary unit didn't exist before Bitcoin. It's the first network where credibility is enforced, not by decree or military power, but by open source code and global consensus. That single innovation changes everything. When liquidity expands in a fiat system, prices rise because units are being devalued. When liquidity expands alongside Bitcoin, the denominator stays constant and everything else reprices around it. It turns inflation itself into the marketing campaign. That's why this isn't a speculative mania. It's a structural transition, a migration from soft money that that decays to hard code that compounds. And just as the world once moved from paper ledgers to digital banking, it's now moving from digital banking to digital collateral. Every empire believes it can steer away from the iceberg, but debt and demographics are unforgiving. You can delay the collision, you can't change the course. The US dollar isn't vanishing tomorrow. It's still the global reserve, still the benchmark for trade and credit. But beneath the surface, the hull is cracking.
I mean, in talking to my friends and getting them convinced to get into it, that's probably unit bias, probably the biggest obstacle I'm now facing. Well, yeah, sure, Larry, but you bought it at 400. Well, I didn't buy a lot, by the way. I was scared of it, and so I bought a little. I bought some more at 10, and I mean, you know, I continue to buy all the way along. And I'm like, yeah, but you can't look backwards. I mean, Max bought it at $2. I mean, I'm jealous as hell, you know, and he told me about it back in the early days, and I didn't believe it because there were 5 others that had failed. I thought this one would fail too. So I effed up there. But set that aside, you know, what they have to ask themselves, if it's $1 million in 5 or 6 years and they knew about it 100, aren't they going to experience regret? You know, and if it's 10 million in, you know, 20 years, aren't they going to experience more regret? And so to me, it's not a matter of whether you buy it or not. It's a matter of what's your sizing on it. And, you know, it's volatile and there's some big drawdowns. And the way you and I both know, there are people who get hurt in it. If you bought right at the top and you panicked in a drawdown, you'd get hurt. That would be wrong. But if you hold for 4 years, it's always come back. It's higher highs and higher lows. And the other model I use a lot, I try and use an analogy, and some say it's a little bit extreme or doomerish, but I like to use it, which is, you know, the U.S. dollar and the monetary system is, in my view, the Titanic. It's going down. It's broken. They can't stop it. It's going down. And so there are these lifeboats floating next to the Titanic, and one of them is called Bitcoin, and the other one's called gold. And, you know, you were fortunate, I was fortunate. And I bought seats in these lifeboat a while ago, and I'm glad I did, because they're more valuable today. And so you, Mr. New Investor, who's now becoming aware of the monetary problems that we face, you know, the seat for me might have been $400, or, you know, in gold's case it was 300, or it might have been, you know, I bought coins at 60,000. Don't get me wrong, but and to you today it's 108. But remember, you're on the Titanic. Do you want the seat?
Gold has been the classic escape hatch for centuries. It stores value, but it doesn't move fast enough for a digital world. Bitcoin fixes that. It's the same physics of scarcity, delivered at the speed of information, global, liquid, and immune to policy. You don't have to sell everything and swim for it. Even a small position is a seat in the lifeboat, an asset that floats when the old vessel finally takes on too much water. That's not ideology, it's balance sheet strategy. When the next wave of liquidity arrives, and it won't feel like prosperity. It will feel like rising prices, shrinking yields, and another reminder that the system can't stop printing. But underneath that noise is the capital migration, from paper promises to digital property. Every cycle pushes more participants into the new system, voluntarily or otherwise. The story of this decade isn't simply inflation or higher grocery bills. It's the repricing of everything that used to be measured in money that loses value.
One, I think that inflation is going to really be the story of this decade, and I think people are underestimating the size of that risk, and they need to be much more aware of the size of that risk. It's about to get worse, in my opinion. Two, if that's the case, the transfer of assets from those who understand that and can adjust their behavior according to that versus those that don't is going to be really kind of mind-boggling. I mean, you're going to really, in 10 or 15 or 20 years, just like who went to work in tech and was an early employee at Microsoft or Google or whatever it might be, you're going to know in 10 or 15 years who understood sound money and saved in things that couldn't be debased, and you're going to know who didn't, because they're financially going to be in much worse shape. And to me, the transfer, the wealth transfer is going to be really significant. And so people need to think that through, because it appears to be going slowly right now, but to you and me who are in it and we're watching it, it's actually going really quickly. It's happening fast. I mean, we're going to be at $200,000 Bitcoin, probably sometime tail end of next year. I mean, it's pretty amazing what's happening. And in turn, if you think these prices are bad at the grocery store, hang on to your hat. I mean, sadly, I think it's going to get worse. I mean, I don't know, the whole pricing thing. I'm turning into my grandfather. I had a grandfather who's from Maine. He was very conservative. He was very cheap. And everywhere he went, he complained about prices. I mean, everywhere. We'd go to a restaurant, he'd get a bowl of soup. It was 50 cents. He was bitching. This used to be a quarter. Yeah. So
And he was right.
he was right.
Yeah.
I'm turning into that guy. I'm turning into a cranky old guy who bitches about prices. But frankly, we're all going to be cranky old, not old. We're all going to be cranky and bitching about prices if they keep printing the way they're printing.
Every monetary reset creates winners and losers. Those anchored to the old world, bonds, cash, fixed income, will preserve the nominal illusion of wealth while losing its substance. Those who adapt early capture the compounding tailwind of the new regime. It's not about gambling on a token, it's about aligning with the architecture of the future. Bitcoin's role in that architecture isn't to replace fiat overnight, it's to provide a neutral, unlevered base asset that absorbs the excess liquidity every time policymakers rescue the system. That process is already visible. Corporate treasuries accumulating Bitcoin, sovereign wealth funds exploring allocations, ETF inflows making Bitcoin accessible to the traditional market. Each step is another vote of confidence in the new base layer. And when you zoom out, you can see the outlines of the next system forming, a world where collateral is digital, settlement is instantaneous, and inflation isn't policy. It's a choice. The Great Reset isn't an explosion. It's a slow inversion of incentives. Governments must debase to survive. Savers must exit to preserve. Institutions must adapt or fade. Fiat money will keep functioning until the confidence behind it finally cracks. And by the time that moment is obvious, the migration will already be complete. Bitcoin isn't rebellion, it's evolution, a quiet recalibration of global finance. It won't announce itself with panic or headlines. It'll arrive through steady adoption, regulatory normalization, and finally, a global consensus. This is the new base layer. If this breakdown helped clarify the macro picture, hit subscribe. It helps the channel grow, and you can always change your mind later. See you in the next one.